Ladies and gentlemen, a little analysis of the silver chart. The silver, well, 1 year chart, only the last 6 months in the 1 year chart we can see here. What we can clearly see is that we have been moving above the 200-day moving average in June, July, August, September, and then in November we drop below it. That is very bearish if we drop below the 200-day moving average. Okay, but the positive thing, we are oversold in the RSI 5 for a longer time. And also at the slow stochastic we are rather big oversold, like we were here and here. And it looks to me as if the slow stochastic is close from crossing its trigger line and going up again. Slow stochastic is very oversold, but it looks as if it is moving up already a little bit, as you can see here. A little bit up already moving, slow stochastic, and it could this trigger line, it could cross this trigger line very shortly. And the RSI, yes, oversold since the 11th of October, kept in this oversold territory, but this cannot go on forever. And in the MACD, the histogram, the bars in the histogram already getting a little bit smaller. That is a sign of buying pressure of selling pressure weakening. Here the bars, here this was the biggest bar to the downside, and here and here and here the bars from the MACD already getting a little bit smaller. So that is a decrease of selling pressure, a little bit decrease. Yeah, the MACD, you are also oversold a little bit. Okay, let's go to the 3-month chart. Yes, in the 3-month chart you can see also we are below that 200-day moving average, and we are at the bottom of this Bollinger Band. Not totally at the bottom, but close to the bottom. Yes, so at least I expect a rebound. A target for this rebound could be the 200-day moving average at 1760, or the middle of the Bollinger Band at 7050, to get rid of the oversold situation. Afterwards, because then, yes, we could drop once again to the $16 level, to the $16 level, to get a double bottom at the low 16 area for silver, maybe, and then a new big up leg. Or maybe even after this rebound to the 17.5, 17.6 area, maybe silver can get back above the 200-day moving average, but I don't think so, because interest rates have already been rising in the last few days and weeks after the election, and that is big pressure to the gold market. As long as these rising interest rates don't bring down the stock market stronger, at the moment the stock market is rising in spite of also rising interest rates, and so as long as the stock market does not come under pressure by these rising interest rates, people will surely not buy precious metals so much, but go into the Dow Jones Industrial Average and out of bonds. But once the rising interest rates that causes people to get out of bonds will also negatively affect the stock market. When people finally realize that rising interest rates are very bad for the big companies, because they also have to pay more interest, more money on their debt, on the interest on their debt, then they will get not into stocks, or maybe even out of stocks, and then finally into precious metals. But that can take a little bit more time until the people recognize this. Most people have a very long time and need a very long time until they recognize even easy things. So I expect the silver price, because it's so much oversold here at the RSI and slow stochastic, and is really ready for a rebound. But I think the rebound will stop at the 1750, 1760 level, at the 200-day moving average, and at the middle line of the Bollinger Bands. And afterwards I think it will drop once again, maybe a little bit lower to the 16 level, 15.90 level, $15.90, $16. That is the lower end of the Bollinger Band. And then we could get a double bottom here, and afterwards I think a new big move will begin, beginning of next year, when finally people understand that rising interest rates are not good at all for the stock market. Not good at all in the long term for the stock market. So rising interest rates is a reason to get out of bonds, what we already see now, but definitely not to go into the stock market, except in companies that have very little debt. But even these companies will negatively be affected, because the consumers will also have less money to spend, because if the consumers also have to pay more money on their debt when interest rates are rising, they have less money to spend, and the companies can sell less products. Even the companies that don't have much debt by themselves are negatively affected by rising interest rates, not because they have to pay more money on their debt, on the interest payments, on the interest rate payments, but simply because they have less consumers that can buy their products, because the consumers often in America have also a lot of debt, and with rising interest rates they have to pay more money on the debt, interest rate payments, and can spend less money on consumption. But that, to understand, the people take a little bit longer. So I think rebound silver to this area, afterwards dropping again to the area where we are today, a little bit lower, and then finally beginning of next year, when the stock market finally comes under pressure big time because of the rising interest rates in the bond market, silver will really begin to get up big time to the 21 level, a little bit consolidation there, and then 25, my final target, April-May 2017. Because there is no much alternative than to precious metals, because rising interest rates will bring down bond prices and will bring down the stock market in 2017, and will also bring down housing prices, because rising interest rates are also very bad for the housing prices. Are rising interest rates not also bad for the precious metal markets? That depends on the inflation. If inflation is higher than the rising interest rates, then precious metals are not at all affected by the rising interest rates. If inflation rises faster, which I expect, than the interest rates are rising, then precious metals profit from rising interest rates. The stock market, not that much, because rising inflation eats away money from the consumers, and rising interest rates also eats away money from the consumers. Rising inflation increases the cost of products for the consumers, so the consumers can buy less products, and rising interest rates causes the consumers to have to pay more money on their debt at the banks, and so they also have to less money to spend. So the stock market, by rising inflation and rising interest rates, where inflation rises a little bit faster than the interest rates, the stock market is much more negatively affected than the precious metal market, because the precious metal market is not bought by the small consumers, mostly by the big investment companies, or by the big money, and by private people with much money. And yeah, so it doesn't, and these rich people, inflation and rising costs does not hurt them so much. They have enough money, so they just want to save this money from inflation, and if inflation is a little bit higher than the interest rate rise, they will go into precious metals and not into the stock market finally next year. Okay, once again, now you can get in and make a little bit rebound trade to this area, but then get out, and wait until it drops again down here, and then you can stay long for long term until 21, 25. That's my opinion. We'll keep tracking this.